Welcome to the Real Estate Deep Dive with Paul D. Garrison from JP and Associate Realtors. Today we're going to be talking about why this housing market is not a bubble ready to pop. So let's start out by taking a look at home price appreciation since World War II. Why since World War II? Well, World War II was really kind of the start of the modern day housing boom. Think about all the GIs coming back from the war and the GI Bill helping them to be able to purchase a home. That's whenever we've kind of saw the beginning of the boom that we're still in. We're actually gone to present day where about 2 out of every 3 individuals own a home now. So since World War II, there's really been one time that homes have lost a significant amount of value, and that was in the last housing crisis. And that was really caused by two things. First was loose lending standards. There were a lot of loans out there that you could get without any kind of income or job verification. And then the second thing is that a lot of people kind of use their homes like an ATM. They ended up pulling out the equity that they had in their homes. They used them to purchase vacations, second cars, jet skis, that sort of thing. So when prices did start to drop because of those looser lending standards and some of the foreclosures associated with that, that problem was actually compounded because people had less equity in their homes, and they found themselves underwater in those homes, and a lot of them walked away. So many of my clients are seeing headlines like this one back in April: foreclosures surging 181% to highest levels since March of 2020. Like I say often, headlines do more to terrify than to clarify. You really have to dive into the article and see what's actually going on, put it into context. So if we take a look at actual foreclosure filings all the way back to 2005, we can see that, yes, they have increased here recently as the moratoriums have lifted and that sort of thing, but they're still nowhere near even pre-pandemic levels. And actual completed foreclosures, REOs, are actually even lower. The Adam report that I just pulled those last two charts from actually has Texas having a whopping 4,982 foreclosures in Q1 of 2022. That actually put Texas ranked about 23rd in the nation as far as the number of foreclosures. So again, while we've seen an uptick in the number of foreclosure filings, that's still well below what we were pre-pandemic, and especially well below where we were during the actual last housing crisis, when we were up in the 800, 900,000 filings per quarter. Now, I know a lot of people are still saying, well, wait, there's still a bunch of houses that are in forbearance. Actually, those forbearance numbers have been edging downward since back in May of 2020, when we were at 4.76 million, and today we're down to just under 690,000. So you've probably seen this from my previous deep dives, but what's actually going on with the homes that are coming out of forbearance? How are they ending up? Well, about 37% of them are paid in full. These are the guys who probably took forbearance as just kind of a safety net. They weren't sure what was going to happen with the pandemic, and they wanted to have it there as a net, just in case. And 44.6% of those have worked out some sort of repayment plan with their lender, whether that's been a deferral or some sort of modification of their loan. So that leaves 18.4% that are still in trouble. About 17.1% of those have not worked out a loss mitigation plan with their lender yet. About 1.3% have actually ended in short sales or deed in lieu. So even if all 18.4% that are in trouble end up in some sort of short sale or foreclosure, that would only be just under 127,000 homes that would be going out onto the market. Currently, given the low inventory that's spread across the U.S., I think the market could easily absorb that with little impact to pricing. So let's take a closer look at lending standards, since that's one of the things that got us in trouble last time. So lending standards are nothing like they were in the early 2000s. There's two parts to look at when looking at risk involved with lending. One is product risk and the other is borrower risk. Product risk has pretty much been eliminated. You don't see those no income, no job verification type of products out on the market anymore. And borrower risk has actually been curtailed quite a bit. So you can actually see how lending standards have actually gotten tighter since the crash. This is a chart of the volume of loans in billions that have been given to people with credit scores less than 620. So you can see back before the housing crisis that quite a few loans were given out to people with lower than 620 credit scores. After the housing crisis, you can actually see that the volume of loans that are given out to individuals with credit scores below 620 has actually dropped considerably. As I mentioned, a lot of those looser lending products out there that had no income verification, no job verification, etc. Those are no longer even offered in the market, but we do still offer adjustable rate mortgages. Now, adjustable rate mortgages aren't necessarily bad. They sometimes are just misused. One of the compounding issues that made the last crash so bad was that interest rates rose, and that caused payments to rise. And as I'd mentioned, many individuals had cashed out the equity in their homes and found themselves where they couldn't refinance because they were now underwater on their homes. This, of course, made them end up deciding to walk away from the homes, which again compounded the issue in the last housing crisis because we had a larger number of foreclosures because of that. Now, the good news is we're, again, not in any situation like the last housing crisis. We see that during the housing crisis time that we were seeing 34 to 37% of mortgages were actually adjustable rate mortgages, where today about 1.7% are adjustable rate mortgages. Another issue that comes up is inflation. So as inflation goes up, people won't be able to afford to make the payments on their homes. So to help address this concern, let's take a look at this study from the Fed that looks at household debt service ratios for mortgages as a percentage of disposable personal income. So this sits at 3.8% today. So back in 2007, we were as high as 7.2%. But even looking back a little further than that, back to like January of 1991, we were at 6.2%. And even then, we're still lower than we were back in January of 1980, which was 4.4%. So if anything, this number has actually been sliding quite a bit since October of 2007 when we kind of peaked. And you actually see that the low interest rates we've had over the past couple of months and the refinance boom that a lot of people have taken advantage of has helped to drive this actually even lower. So it's really not a debt servicing issue. So we've kind of covered the reasons why I think there's not going to be a crash or a bubble burst in the housing market. But don't just take my word for it. Let's take a quick look at what some of the industry experts are predicting as far as home price appreciation and forecast for 2022. Now, this is a slide that actually was used back on January 19th of the beginning of the year, where I went over the top industry leaders and what they were predicting or forecasting for home price appreciation in 2022. So you can see the average forecast was 5.2%. And again, it ranged from NAR at 2.8% all the way up to Fannie Mae that was predicting 7.4%. So next time you see me use this chart is actually in February 25th's deep dive. You'll notice the average has gone up to 6.13%. That brings us to today's forecast. You can notice that the average has now gone up again to an average of 9%. The forecast range anywhere from 10.8% to 6% appreciation for 2022. So the key takeaway from this is that no experts are calling or predicting that homes are going to lose value in 2022. If anything, we've actually seen their forecast rise over the first couple of months of this year. Many of the metrics and numbers in this presentation are based off of the national real estate market. However, local areas can vary. Please give me a call and we can discuss your situation. Have questions about your specific needs or location? Please contact me at 214-683-8188 or paul@pauldgarrison.com. Want more information about the housing market and related issues? Be sure and check out my blog at www.pauldgarrison.com. Thank you for your time. Please take a moment to visit our website at www.pauldgarrison.com.